7% may be too conservative. That's Michael Patra, the RBI Deputy Governor. Latha standing by now to take us through her take on the policy. Latha, as expected, as far as rates are concerned, status quo continues. The RBI Governor also cautioning that one shouldn't assume this to mean that the position has moved to neutral or that there is any loosening around the corner. But on growth, Latha, I mean, 7% too conservative, says Michael Patra there. What do you make of the comments that came in?
I would agree that the standout message of this policy is that the RBI is much more optimistic on growth than one thought they would be, than definitely what the market is at this present. It's actually an across-the-board revision of growth. As you can see, the entire FY24 has been revised by half a percentage point. You know, that's big. And then, we already know that the second quarter is 7.6 compared to their earlier estimate of 6.5. But Q3 has been again revised up by a full half a percentage point. Q4, we already had a forecast of 5.7 from them, gone up to 6. FY25, we had one forecast from them up to quarter one. That's been revised higher by, albeit only 10 basis points, but still revised higher. Q2, these are new forecasts. We didn't have an older forecast for that from RBI at 6.5% and Q3 at 6.4. But that brings the Q1, FY25 forecast of 6.5. There's no one on the street with such a strong forecast. The forecasts were mostly 6.5 to 6.7 for the current year and 6.2, 6.3 for next year. So the Reserve Bank beats all of them by at least half a percentage point. But there is one thing to say in favor of the Reserve Bank. From the start, they have been maintaining that the GDP for the current year will be 6.5. The entire street was at 6 or below 6. They are catching up with the Reserve Bank. So, the bias, when you look at the performance of forecasts, you want to align yourself with the Reserve Bank. They've got it right more than anyone else on at least growth. So, well, if they're tom-tomming 7%, it takes one's breath away. But it's clearly the standout message from the policy. The others on inflation, they've not changed anything, actually. They've maintained all those numbers as is. The important point to note is that when we come to the next year, second quarter inflation eases to 4%, but that's everyone's number. I didn't get any different number in the street. There were some people even below 4. And 4.7 for Q3. This would mean that, just as you get that 4 number, the policy that comes around that time is August. At that time, will the Reserve Bank move towards neutral and a rate cut? That's the guess that the market is at now. The Reserve Bank, however, didn't give out anything like that. They continue to maintain that the policy will be disinflationary, which means it will work to bring down inflation. And let's come to the stance. The stance quite clearly reiterates the previous stance. Okay, a word about food. They're worried about food inflation, but they do claim that core inflation has come down because of their efforts. Those are just a few details on inflation. But on stance, they've absolutely unchanged, whether it's a question of the withdrawal of accommodation or whether it's a question of liquidity tightness. There is absolutely no change in the wording. In case someone missed it, they said that OMO, the open market sales of bonds, to absorb liquidity is very much a tool. It is on the table. Perhaps if you want me to summarize as 2 key takeaways, one is the super optimism on growth, and 2, the fact that there is no shocking element. Previous 2 policies, they shocked us once with an ICRR, incremental cash reserve ratio, and last time with an OMO sales threat. This time it was no such shocks. That was the shock.
All right, Latha, we will take that. Thanks very much for joining us. Latha, there's summing